I'm sure by now everyone has heard of what is happening between the redditors on Wall Street Bets and the hedge funds on Wall Street. In this video, I want to provide a quick explanation on why and how the hedge funds are losing billions of dollars so quickly. Thanks to the pandemic and government-mandated shutdowns, retailers have been struggling to survive. GameStop has had two very large hurdles to fight: the pandemic and advancements in technology. Since GameStop is a retail business, it is considered non-essential, thus making it one of the first businesses to be shut down during this pandemic and one of the last to open back up. Of course, this depends on where you live. Thanks to advancements in technology, companies such as Sony and Microsoft allow video game players to purchase and download video games directly to their gaming consoles, which in turn fundamentally hurts GameStop's core business. All of this in turn doesn't make GameStop a failing business, nor is the business going bankrupt. But it does hurt the company extensively, and these factors played a role in driving the overall stock price of GameStop down. In came the hedge funds. They realized the extent of damage happening to GameStop, and so they took out short positions against the company's stock. As an investor, you can take out two positions against the stock. You can take out a long position or a short position. If an investor believes the price of a stock will increase over time, then that investor can take out a long position on the stock by buying and holding shares for the future. On the other hand, if an investor believes the price of a stock will decrease, they can take a short position. When an investor shorts a stock, they're trying to sell shares they don't actually own because they think they can make money later by buying it back at a lower price. Here's how it works. An investor borrows shares from a brokerage and sells them to another investor at the current price. The shares are sold, and if the price of the stock falls, the investor that shorted the stock will buy the shares at the new price. The difference between the stock price before the short and the stock price after the short is the profit made per share. Shorting is very risky and has the potential to lead to infinite losses because theoretically, a stock price can increase infinitely. So how are the hedge funds losing money? The hedge funds have taken out huge short positions against retailers like GameStop, basically betting against the retail market and hoping their stocks drop in value so the hedge funds can make a giant profit at the detriment of retail companies. On December 31st, 2020, it became apparent just how large of a position the hedge funds took out against GameStop. According to Morningstar.com, investors were trying to short 260% of GameStop stock. The hedge funds were basically betting on a decline on more shares than even exist. Redditors from Wall Street Bets found out about these positions and began buying GameStop stock. In turn, this caused a short squeeze. The hedge funds bet billions on GameStop stock dropping in value. The price increased thanks to retail investors, and the hedge funds had to purchase the amount of shares they bet each day at the new higher price. Over the past few weeks, the price of GameStop stock has increased dramatically, and as a result, the hedge funds have lost billions of dollars. If you are thinking of investing into this short squeeze, just know that it cannot go on forever, and GameStop stock price will eventually return to a reasonable level. Invest at your own risk, and thanks for watching. If you enjoyed the video, don't forget to leave a like, comment below, and subscribe to the channel. Thank you, have a great day, and I'll see you in the next video.